it or not. We're going to be digging in on the non-farm payrolls that just came out. We're going to be talking about the reaction of Fed fund futures and bonds. We're going to be hitting on what's going on with the credit crisis. There was a story about Blackstone that we definitely want to hit on. We're going to be talking about whether there is a true rotation out of chips and much, much more. So it's time for State of the Market. Let's roll credits. Good morning, everybody. Good afternoon to my friends across the pond. I am Mark Sebastian. I am your only option. Welcome to the State of the Market Show. We're here every day at 10 a.m. Immediately following I Trade That with Garrett Baldwin, breaking down the most important topics and stories of the day, giving you trade ideas and much, much more. To start the day off, we have the Dow Jones Industrial Average down about 77 points. 0.15. That is the calm index. That is the index that is not much moving. And we're going to talk about maybe why here in a second. The S&P is down almost 1%, has been down as much as a little over 1%. And the real bloodbath is in the NASDAQ 100, which is currently down 2%. VIX waking up, trading up about 1.1 to 16.5. And oil pretty much flat, down 2%. What's driving these moves? Well, one, a continuation of yesterday's selling in chip stocks. Two is the big news that hit today, which is non-farm payrolls. U.S. labor non-farm payrolls up 172,000 jobs. Consensus was 80,000. That is a massive beat. To make matters even better on the labor market, March jobs were revised up, 29,000 more jobs. So March, we made 185,000 new jobs, up to 214,000. 214,000 jobs in March. April was revised up by 64,000 from 115 to 179. So that's on top of the big beat. The market was looking for about 80,000. We added an additional 93,000 jobs in March and April. This is a bullish labor force jobs report. The most interesting piece out of this jobs report was that for the first time in a very long time, the most jobs added to the economy were not in healthcare. They were in travel, leisure, and hospitality. So big, I think that's important. That shows you that the American consumer, at least the top end, has not been really thwarted by gas prices, and they're still out spending. Digging a little deeper, the unemployment rate pretty much unchanged, 4.3%. Average hourly earnings up about 12 cents an hour to $37.53 an hour. Year over year, that's 3.45%, right about in line with inflation. Private sector payrolls were the leader, 120,000 added. So, folks, this is big news, and this is having a cascading effect on the bond market. The bond market in particular. And I'm going to have Tim on here in a second, and I want to get his comments too. But I want to show you what's happening in markets. What you're looking at, and I'm going to refresh this just because this doesn't update dynamically. What you're looking at is the outlook for rates in December. This is the final meeting of 2026. And I want you to pay attention right here. I mean, if you can zoom right here, please do. Going into yesterday, we had about a 50% odds of no cut and 50% odds of a hike. After this announcement, we're down to about a 32% chance of no hike, and now over 66% odds that we're going to have at least one rate hike, and 25% odds that we get a second rate hike between now and the end of the year. You want to know why the NASDAQ is under pressure? It was already going to be under some pressure because of chips. And we're going to talk about that in a second too. But you start putting pressure on rates, which push pressure on working capital, raises borrowing. Gee, is there borrowing for AI? Oh, yeah, a ton. Rates higher raises the cost of capital across every single lever that companies can pull. And that is going to be a problem for the AI build out. Affects a lot of other companies as well. But that is why the NASDAQ, on top of the pain in the chips, is falling. And, looking at that pendulum, we continue to see rates softer. Keep an eye on IEF. I've told you guys, watch IEF. We got a respite on May when things looked like they were about to fall over. Got a nice run back to the 50-day. And now IEF is pulling back again. Folks, we get a top in chips. We get the SpaceX launch, the SpaceX IPO. We get the bond market starting to fall apart. That is your recipe for a tough week next week. And there's one more part to this. Higher rates are a problem for credit across the board. So let's bring in, I want to talk about that in a little bit more detail now. Let's bring in our own Tim Colby. I want his reaction to non-farm payrolls. And then I want to bring in, I want to talk about what's happening in private credit behind the scenes as well. So let's bring in our head of macro. He is Tim Colby. Good morning, Tim.
Hey, how you doing, Mark? Happy Friday.
Happy Friday. Good to see you, man.
Good to see you.
So that non-farm report caught the market extremely flat-footed.
Yeah, I mean the 10-year and the 30-year, even the 2 and the 5, they were been coiling up since May 25th. I have them on my screen, and they just kind of been up one day, down the next, up one day, down the next, kind of back and forth. I look at a 15-minute chart, and I got to tell you, it's just trading the same price within a one ATR band since then. And all of a sudden, I'm looking at the thing this morning at 6:30 here, Colorado time. That number goes off, and it was like, oh my God, that number is a monster. I could see it in the futures before I could see it hit the tape. It's just, it was a little bit hotter than everybody thought. And they're like, well, wait a minute. I thought AI was cutting jobs. I saw somebody posted that in the chat. I'm with you. That was the thought. But really, the economy's hanging in there. And it's amazing. A day, how much it can change in a day. So yesterday, really, you mentioned Broadcom earlier, and the big thing that was going on was the chip stocks for the last 2 months, right? Semiconductors have gone on an absolute tear. The biggest rally, I think, in the history of these things. I mean, it's just, I think Micron or the stocks, they were up 17 days in a row or something. It was just very, very impressive. It was a one-way trade. Anything AI, anything with the build out, anything in that space, you had to buy it. You go look at the NASDAQ names, you can't find a NASDAQ stock to sell. There isn't anything in there to sell. Everything looks like it's going to the moon. But you look at the rest of the market and you think, well, what the heck's going on with banks? And what's going on with consumer staples? Those are falling apart. You have Walmart's falling out of bed. Costco's falling out of bed. all of these names are getting beat down, and the whole narrative is about the customers, the consumers getting pinched by the high gas prices. That's kind of the narrative. Well, now you get Broadcom had maybe not a good earnings report, and you get a little prick. I don't know if it's a prick in the bubble or if it's a hiccup. Look, I haven't shorted the stocks this whole way up. I haven't shorted the NASDAQ even one day since the ceasefire. You know how proud I am of myself?
You should be
for
proud.
not selling even one day. I actually went long. I mean, I was long early, but then normally, an options trader, we put our, we're a mean reversion kind of a style.
Yeah.
Things go up a lot. You kind of sell them. You look to go back down for a trade. But this was a freight train to not get in front of. It was really a one way ticket to the moon. What was really interesting yesterday, you've heard of a relief rally, right? You all know what a relief rally is, right? Vol is really high. Everybody's worried things are going to happen. And then the bad thing goes away and volatility goes off and the stocks rally. It's called a relief rally. Yesterday, I'm going to coin this. Yesterday, we had a relief sell-off. We had a relief sell-off. And the tell was, in the morning, Broadcom, it was down a bunch, right? I read the headlines. I'm like, oh my God, Broadcom's down 15%. It's crashing. The headlines look terrible. And you're like, well, what do I do? What do I do? It's trading, it's trading a price that it was trading 4 days ago. It's like big deal. Like, yes, 15% is a lot, but like it was trading there on Monday. It didn't really go down that much. Now, the point is when you see that and everybody's long the chip stocks, you're like, oh my God, the market's going to crash. But then you look over in the Russell 2000, the little stocks, that's usually they're a beta, so they go and outperform. Those stocks were up. So you had the Russell up, which is a beta stock. You had the NASDAQ down the most, down 1%. And then the E-mini, the S&P futures were down also. Then you look over and the VIX futures are actually down. Now, this is yesterday.
Yep.
The VIX futures are down with the one-way ticket to the moon is down. So you had this very, very weird relief sell-off. It was kind of like an exhale where everybody's like, oh, thank God. Maybe it's just, we're not going to, explode to forever.
Yeah. You can see that vol, and I was talking about this yesterday on the show, right? SMH is down 3% and vol is in. That tells you how kind of overbaked that it had become. Once you see vol start to correlate with the stock price, so option prices going up as the stock price is going up, that's your sign that a market is getting. That's your sign that a market is getting overly frothy. Now, Tim, speaking of markets that are maybe not overly frothy, Blackstone, private credit, kind of got swept under the rug with Iran. All right.
It did.
Then the news comes out. Investors wanted to redeem about $4.5 billion worth of Blackstone's $79 billion fund, and they shut it off at 5%. They said, nope, we'll give you a percentage of what you want because we don't want to fully redeem. Now, the previous quarter, do you know what they'd done? They redeemed everybody. They didn't want to do it.
That was the first go. That was the first go. Look, I am one. I do have a great hairdo, Hogan. Thank you. I appreciate that. Everybody in the chat, I hope you're having a good Friday. Look, I am one to eat it when I am wrong. And this, thank God, I was not that badly wrong this time. But the Blackstone had gotten taken to the woodshed with the IGV. Mark, if you pull up IGV, that's the software index.
Yeah.
So it's got all those software companies. And what was the big worry with private credit? The worry was that Claude was going to all of a sudden code away every single software company on earth. CRM is going to go away. The Salesforce is going to go away. ServiceNow is going away. Like, they're all going to zero. And that index went down. Well, if that's going down, the public companies, what's going to happen to the private companies that are even smaller, like they're definitely getting hurt. So they go all the way down. And what chart do you got here? IGV, right? So it show a daily, compress it a little bit so we can see the big sell-off from, let's call it November of last year. Let's go give it a year.
There you go.
You can see a rally. You can see, right? So it kind of bottoms out. And then if you, I don't know if you can overlay charts, but if you can overlay Blackstone over that chart, add another chart to it, and you'll see Blackstone, Blue Owl, Ares Capital, all of these BDCs, all of these private credit companies. Look at that. It's like a 1-for-1. They track right over each other because there was all this worry about the software space.
Yeah, except Blackstone actually underperformed IGV, which was one of the worst assets to own over the last 6 months. Blackstone's actually performed worse.
So you have this rally in the IGV, and I call markup. And look, this is why we have Option Pit. This is what we're doing here. We have a community of people that we're talking to each other. That's why you have the chat. Like, I love seeing what you guys put in the chat. Yeah. This is why we have a community. We talk to each other. This is a kind of an important thing for you guys to understand. I see IGV rally. Now, I'm an options trader. A lot of things what we do, what I did for my entire career, the way I made all the money I ever made was I would watch everything. You just watch everything and you understand what is correlated to other stuff. It started really early with put skew and call skew versus, 2 different months of the same stock. Then it was different months of 2 stocks that were correlated. And then you start to look at more things. But when you get into direction, you start to look at correlated stocks and you're thinking, okay, what are the knock-on effects of certain things happening? So I see IGV rally. And if you can see in that chart, you put that line there, IGV goes almost all the way back up to the high, right? And I'm thinking, oh my God, this IGV is rallying so much. Mm-hmm. What does that mean for Blackstone that got taken to the woodshed with the software coming down? So I call Mark. I'm like, Mark, I think I'm going to do a special situation in Blackstone and even Blue Owl. I see Blue Owl is getting into the series club. It's getting open interest and they want to buy it. So I buy a chunk of Blue Owl calls, and I bought enough that I was a little nervous about it. And I'm like, all right, now I know I got a bet on, and I got more room to buy more. Let me call Mark and let's talk this one through. So we talk it through, and when you put a position on that's maybe a little too big, you start to ask yourself a lot of questions about, like, how could I be wrong? And you get fleshed out. I started to realize the big difference between what is in IGV versus what is the software piece that's in Blackstone. The stuff that's in IGV has moats. They have moats. They have an established business. They have basically a way that Claude is not going to penetrate their business model. And those companies are going to rally. They're going to go up. And I wasn't really sure. There wasn't a lot of news about the private credit stuff yet. But I started to think, all right, maybe I'm wrong on this one. Let's back off. I took down the Blue Owl calls. I think I lost a nickel on the calls. Bought them for 75. Took them off for 70. But I kept a small, tiny bit of Blackstone because I'm like, you know what? That's a long-term hold. I'm cool with that one. They're longer dated. And sure enough, I think it was that night or the next day, Cliffwater comes out and they said investors wanted to take out 17% of their funds. And they said, well, no, there's a gate at 5%. You can't have it. Now you can't leave. And then the next day, Blackstone. So like it just all of a sudden came back, and that answered the question of, yeah, maybe we were wrong.
You can welcome to the Hotel Blackstone. You can check out, but you can never leave.
That's crazy.
All right. So Tim, I actually think there's some opportunity here. I think we're going to be it's certainly in Delta Strike. We're going to be looking at Blackstone. We're going to be looking at BlackRock. We're going to be looking at Blue Owl and some of these credit things because, you add in MSTR, which I don't want to dig into today. We're going to talk about more about it on Monday. You've got a recipe for private credit, especially with the move we're seeing in rates today, to have some serious serious problems over the next couple of weeks.
What's interesting is that we didn't even get into interest rates. And if you look at the board today, go look at something that's been really bad is the banks, right?
Mm-hmm.
Look at consumer, look at the healthcare. The banks, they actually like rates higher. Banks like rates higher. Energy likes rates higher.
They like rates higher and stable is what they like.
Stable.
They like rates higher and stable.
But you're actually seeing like healthcare is starting to break out to the upside at XLV. And it's like, look at so a couple tickers out there in the chat. You guys look at like if you look at Humana, HUM. If you look at Cardinal Health is starting to. So Cardinal Health is one I want you to look at. I think I'm going to go grab some calls on those. UNH and CNC. These are all the healthcare providers. So I ran a momentum finder on all of the stocks that there are, and I noticed that healthcare is breaking out. Industrials are breaking out to the upside. And this is what I noticed yesterday. If money is coming out of the chips, it's got to go somewhere, right? They rotate. That's what people do. And I noticed yesterday, all of these unloved sectors were getting purchased. They were getting bought. And so you start tracking down, like, well, what are they buying? And they're buying healthcare. Like they're buying the healthcare stocks. And I'm liking it. So I think it's CAH, Cardinal Health. I like that one.
Yeah.
I'm gonna grab
and this has a lot to do, and this has a lot to do with a rotation that we're taking, I wanted to spend a few minutes on. We're starting to run out of time here, so we got to talk about this somewhat quickly. No, you're fine. People. Oh no, Tim said something insightful. How dare we? But you made a comment about this in our trader group, right? You said, guys, this isn't really the market sell-off that you think. Yes, chips are down, but take a look at the Dow Jones yesterday. It was up 900 points. The NASDAQ is down over 2% right now. The Dow Jones is down 0.25%. Equal weight S&P, all right, is down 0.5%. So what you're seeing is money is not exactly leaving the market yet, but it's kind of getting out of some of these hot areas like chips, and it's jumping into healthcare. Look at the move that we saw, after, and this was, I got to tell you, a fabulous trade by me. I'm going to give myself props here. I bought the. This is Deere and Company. I bought the 480 calls on in the money on the 29th, and sold them. I think I bought them for $60 and sold them at 100 and something or other. So, but you're seeing manufacturing taking off. Deere, Cat, and so a lot of the boring old line stuff. GE starting to pick up. Money is finding new places to go, but that tech trade is taking a pause. And you had a kind of something you wanted to share on this, that you're going to take approximately 90 to 120 seconds to walk through.
Yes. Are we going to share a screen? This one's a little messy. I have this one. Oh gosh. Where are we? There. This one? Share that. My bad.
That's the one. You're good, Tim.
Sorry. This is a hot mess, right? I just kind of built this thing up. Wow. The summary tab. Here we go. So momentum, what does this do? This is large caps. Let's zoom in a little bit so you guys can, I don't know if you guys can see.
They can in just a second, Tim. I just need to hide some things before I show you screen.
Sorry.
We'll see in 1 second.
Are we not sharing it?
There we are. Yes.
Okay, great. Okay, so this is large caps. What I did is I took a simple trade strategy, a simple momentum breakout trade strategy. I think it's funny that Garrett uses 1 day off of what I use. I use a 9-day and a 21-day for a short and a sort of medium term. He uses an 8 and a 20. I watched him on the show. I thought that was funny. Everybody has their own favorite little moving average lines. In the chat, if you have a favorite, throw it in there. I'm curious to see what everybody does. because everybody's got something different. My mentor always used Fibonacci numbers for his. I thought that was really funny. But what I did was I took a simple, stupid breakout. The 9-day moving average crosses over the 20-day moving average and a stock is breaking out. Then you lock it in until the stock goes back down below the 21-day moving average. Then you run a count. How many days is it in the trade, and is it winning or is it not winning? So if we go to the winning tab, this is the winning tab. Let's scroll in to make it so it's not so bad. And then basically what I did is I did a count. How many stocks are in and winning? And then I broke it down by large cap, mid cap, and small cap. So I did 500 stocks in each, and I did a count. And what you notice here is this is a little bit, if I could zoom in more, I'm trying to see two screens at once. This is a little bit sorted by volatility. And I didn't spell energy right. This is late. You have tech, energy, consumer discretionary, all these things. If you notice up here, the old guard, the oldest trends that are still active in the market are mostly up in tech, large cap tech. We can go down here at the bottom. You can see this is a summary, the composite of all of the breakouts that are happening. These are the old ones. These are the mature ones that are anywhere from 11 to 22 days plus. And these are the ones that are just coming up. These are 1 to 9 days plus. So what you're seeing is that you have this locked in tech rally that's happening, but you have these new breakouts. Consumer discretionary industrials are starting to break out. Healthcare is breaking out. Financials are starting to break out in these 9 days, right? What I did over here is I took the stuff that's breaking out to the upside and the stuff that's breaking down, and I subtracted them. I said, okay, if you have stuff breaking down inside the sector, stuff breaking up, let's take the net. So I had the net of these. In the net total trend, you can see it's NASDAQ. You got consumer, we got consumer discretionary, but you can see I took the news trends and the old trends. You can see consumer discretionary here is starting to break out. Industrials are breaking out. Healthcare is breaking out. But these are old, these are established trends that are bad, net bad. These are the things that were bad, and these are the things that have an established trend over here. That's the net. And the point is that the market trends, we could probably take that down. I mean, for now, the market will trend and show you where money is going. And the whole point of this is to track money flows, to figure out when they're taking money out of the chip stocks, where are they putting it? They're putting it somewhere. And when you can track the market like that, that's how you can start to find some of these trades. Like, I really like this Cardinal Health. I think that's really good. I think that's where I'm looking at this healthcare sector. Yeah, it's just, you just start to follow what's flowing through the market. You can start to see the flows, and
you just had CAH break. You just had CAH the 9-day break over the 21 on the 22nd of May. So you're just seeing that.
With the S&P down 1%, they can't buy enough of that.
Yeah, it's up 2.5%. It's a nice move. All right. So Tim, I want to real briefly talk the change in pattern day trading. And this is more for everybody here. All right. Everybody here, whether you've had $25,000 in your account or not, has the rule changed your thought process, changed any part of your trading? If the answer is yes, type in the integer 1. And if the answer is no, type in the integer 2. I'm very interested to see how you guys are being affected by this rule change. I know many of you are Schwab users, and that doesn't come into effect until Monday. But I want to know, has your thinking changed? Has any of your habits changed? Is this going to be something that profoundly affects how you trade on a day-to-day basis? Now, Tim, wow. I think this is going to be a big change. For me, one, I don't have to teach things like synthetic closes anymore or backdoor ways for people to exit out of I'm going to fix my alfalfa here real fast.
Oh yeah, I got the same thing going on. I got to get a haircut too.
But more importantly, I'm probably going to open up a test account that only has a few $1,000 in it and start playing with it to see what I can do. What are your thoughts on this big change and what it'll bring to the macro markets?
I think the biggest change here is for the end user, and I'm not really sure there's going to be a big impact to the markets. I don't. The markets can handle liquidity. The markets are very liquid, but I think this reminds me a little bit of when I went from trading on the floor to trading off the floor. When I went from trading direction to trading, from trading volatility to then trading my own capital directionally. And what I mean by that is when I traded options, you kind of had a gate. You had like a lockdown on how much you could trade. There was a set of rules around that. But when you're free and you have your own account, you can just kind of go trade anything you want and just start clicking buttons. You could have some bad habits. You could form some bad habits. And this is a period of time where risk management becomes permission for you to trade. It's sort of like a necessary thing. If you don't have any risk management, if you were under the PDT rule before, you had 3 trades you could do. That was it. But now, what if you traded 20 times in a day? What if you said, I think this is going to go down, and you sell it and it doesn't go down right away, so you buy it back. And then you sell it again and it doesn't go down. And then all of a sudden you're revenge trading. That could happen. It's a thing. And if you never had to deal with that before, that's a new thing. And I think, again, this is what this community is about for. That's why we have this, so you can talk to everybody here. Just kind of share where you're at, share where you are with your trading, because this was a gate, and it was like a built-in risk management that people didn't realize they had. It was like a benefit in disguise. And I think now that they're free, now that anybody who has this is free to trade wherever you want, you got to read a little bit more about trader psychology. And I think risk management's a much bigger piece than anybody realizes.
Yeah, absolutely. Risk management is going to be so important in this approach. We're going to start, and this is part of the reason why it's so valuable having someone like Leisha, who's traded grain futures and hog futures and stuff like that, and understands the risk management inside of day trading assets like that. That risk management on a day trading basis is probably the most important piece. That's where you can get the most into and lose the most money the quickest is day trading. And that's where having someone like Leisha with her incredible background, right? Again, you meet people that understand charts, you meet people that understand options, that you never see those two meet together. And I don't know that would have happened in even Leisha's case if she'd not taken several years off to raise her child. So it's which I know you can relate to. So, but it that's what makes her such an asset to us here at Option Pit, and why Project Next is such an amazing opportunity for you guys. We are wrapping up launch pricing today. I believe we're wrapping up launch pricing today. We had a banger of a win in Tesla. I haven't looked at the trade from yesterday yet, but obviously it's a weird one. So the whole market is being kind of thrown out the window. So I'll be interested to see how that one performs. But what I'd like you guys to do is click the link and join us, or pick up the phone, and maybe better, pick up the phone, call 888-872-3301, ask about how you can get into Project Next, ask about how you can view the masterclass that you did this week on everything from understanding candlesticks to understanding risk management to pitchforks, the whole 9 yards, all kinds of stuff that'll improve your trading. So give them a call, 888-872-3301. Shoot them an email, support@optionpit.com. So join me and Leisha today I look forward to spending some time with you guys. Folks on YouTube or Twitter, please give us a like and a follow, or better yet, email my team, support@optionpit.com, and find out how you can join us in the chat here live every day and interact with myself, Tim, Garrett, everybody here that joins us on our free content here at optionpit.com. Tim, thanks so much for your insight and your thoughts. I'm looking forward to taking a look at Cardinal Health and Blue Owl. So, folks, Tim and myself, and Amin, we hope you have a wonderful weekend and a great rest of your Friday trading day. So, for Tim Colby, our head of macro trading, I am Mark Sebastian. I am your only option. I'll be back with you at 10 a.m. on Monday. Thank you for joining me. Thank you for joining me and Tim. And most of all, thank you, Amin. Have a good one.